Good afternoon. This is Ken Long from Tortoise Capital with a review of the Tortoise trading plan for the weekend of December 21, 2013. To begin, we've got a market that's in bullish normal conditions. On an annual basis using weekly RSI 14, we're at 71 out of 100 or overbought. On a 10-day basis using the 10-day NDX, we're also overbought with a score of 96 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is yellow bullish at 9.14%. Slope of the 50-day moving average is green bullish at 0.75. It improved this week. ADX remains relatively low at 17.2 at the low end of neutral. So there's room for a trend to develop here. ATR percentage remains at the low end of normal at 0.86%. The risk index is a 30-period moving average of the VIX divided by the 10-period moving average of the VIX. That comes in at a score of 0.93, or risk off condition, meaning that the riskier assets are not as favored. You take that score of 0.93 and compare it to the last 5,000 trading days. That gives us a z-score of minus 0.94. You can see the 90-day time series of that indicator here, with the decline in volatility suggesting a potential turning point for the long side here. No change to the blended monthly rebalancing portfolios, with the next reevaluation due on or about 1 January. This week, the theoretical exposure of the ETF2 model is at 70%. The model portfolio itself will be at 100% exposed. Looking at the 13 ETF portfolio, about half are on a buy signal with price relative to their 4-month moving average, with NASDAQ, small caps, large caps, and then the mid caps all in the top 4 positions, so it's all US here. In the 32 ETF portfolio, industrials and consumer discretionary continue to do very well, along with technology, then the small caps. In the ETF Max, which looks at about 1,200 different ETFs, the symbols at the top remain strong. Egypt, solar energy, although it's worth noting that the previous winner over the last 3 months, TAN, is on a cash position with price at 34.67, slightly less than its 4-month moving average at 34.91. These are the top 50 of those ETFs. Looking at the market health check, we have the vertical blue lines represent 10, 20, and 30 days worth of look back. Horizontal red lines are support levels that used to be resistance levels, and which give us continued support. And if price fails through there, then price targets on the way down. The dark blue shaded area is the 30-period Bollinger Band plus or minus 1. That's the river. The lighter blue shaded area is the 30-period Bollinger Band plus or minus 2. That's the floodplain. We're looking at 3 different regression channels here. The blue regression channel is the 10-period regression line and channels facing up with price in the upper half. The black channel is the 30-period regression line lagged by a day. That's also sloping upward, which is favorable with price near the top of that channel. And then the longest term period we're looking at, the 90-day regression channel, is the green line and channel, and that's the strongest of them all. So this bullish market has had some legs and continues to be strong long term. You can see prices in the upper half of the floodplain, and with everything sloping up, that's a very favorable condition. This thin black line is the 30 period regression line slope time series, and you can see in the blue lines where we've marked out key turning points in that indicator. Most recently, what we had was the 30-period slope decaying from this very strong upward slope here. And as the market has been somewhat choppy over the last 30 days, the slope has slowed down, and that's caused us to come back towards the zero line, which is this horizontal dotted line. But you can see that before it went completely flat, it is now starting to slope up slightly. And this little divergence is perhaps some foreshadowing for some other favorable moves. The last time that it did this, you'll notice here, back in October, notice back here in October when it had an opportunity to come back to the zero line. It didn't. It reversed and went higher, and then this led to the next powerful leg up that we've been enjoying for the last 2 or 3 months. So this is potentially another one of those moments where after 30 days of consolidation, we're just starting to look at the upside. So that's got some potential. To the downside, strong support at 177, 74, 72. And you can see down here the 200 period moving average in the area below the curve, shaded red. We're overbought right now on Williams percent R. We can stay that way for long periods of time. And the jaws of PPO closed these last couple days and are prepared to open to the upside, which could be some foreshadowing again for another extended move into the close of the year. Looking at the ETF2 regional summary and the sector spider summary using that lens, we have the S&P at 82, stronger than EFA at 78, so the U.S. is favored over the globals. Inside the U.S., the strength is in the growth areas, or the risk-on areas, with NASDAQ, small caps, large caps, then the mid caps. Two strongest sectors in the world, technology and small caps. Two weakest remain Latin America and Asia, less Japan. Inside the sector spiders, strength continues to be in the industrials at 85, consumer discretionary 84, and technology at 83. In the world market model, we have everything in the U.S. is above average now, with the small cap value and growth, and the large cap growth exceptionally strong. China exceptionally strong. Everything Europe is above average, with Germany and Spain very strong. In the ETF top 30, the leaders continue to lead, with solar, Greece, pharmaceuticals continuing to be very strong. I like these symbols that are green on strength and white on consistency, which is an indication of increasing short-term strength in symbols that were already above average. So we have quite a large stack to choose from. Inside the Dow, using the same lens, Boeing, Nike, 3M remain very strong. 3M moved into second position here ahead of Nike this week, with only IBM and Cisco on the weekend down here in the red. Again, I like those that are green on strength and white on consistency as emerging strength leaders. Looking at the shifting to the daily report for Monday, no signals in channeling or overreaction. You can see the slight increase here in volatility, bringing the market back into the low end of normal for volatility. A handful of signals, a couple channelings in Walmart and Pfizer, triple screens for the VIX and for Nike, and then a handful of quality names here that test out better than 2 to 1 in the auto framer: Microsoft, Nike, coal and silver, Walmart, Johnson & Johnson, and even Brazil makes the list. Looking at the Dow tactical summary, nothing fired on the RSI2 value. We have a handful of dojis, a couple channeling and overreactions, and then the top 5 max pain range compressions: Procter & Gamble, Walmart, Microsoft, Johnson & Johnson, and Nike. So at the ETF2 lens, no symbols that fired on the RSI2. Just a couple with exceptional fraud quality numbers. 2 dojis in oil and materials. Here's the triple screen in the VIX, which has a 3.4 reward to risk ratio. And then the top 5 in the auto framer being coal, Brazil at 2.4 to 1, gold, silver, and Latin America. So we have some reasonable opportunities in the ETFs as well. Stats from the auto framer for those of you mechanically setting up your frames, and quite a few test out very well on the reward to risk ratio, as you can tell in this column. Slope of the 30-day regression line is still positive. It's near its 6-month average. You can see in the time series as it's pulled back from pretty high levels that were more than 1 standard deviation above normal. I would expect this to start improving now if we get any kind of continuation of the momentum trade. The remainder of the chart's just for statistical purposes. I do want to highlight on the z-scores of the regression lines. You can see that the 90 is still showing an exceptionally strong long-term market here, remarkably so. The 30 has started to slow down its decay. The 10 has rebounded, so there's still room for another 5% bump here, especially now that we've tested the bottom of the river and now are near all-time highs. We could have another leg up here. After each previous test of the lower boundary of the river, you've seen we've had nice responses in the last 6 months. And that's everything that I want to cover for this weekend. Keep your powder dry and enjoy this Merry Christmas season. We've got a white Christmas going here in Kansas and a little bit of soccer tomorrow. So take good care, and we'll see you in the chat room.